Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. I'm Ethan, ready to dive into the market buzz.
And I'm Brooke, here to scrutinize those numbers.
Well, we've certainly got a packed agenda today, Brooke. Our AI sifted through a mountain of social media discussions from yesterday, Friday, January 2nd, and it flagged quite a few different stocks. The overall sentiment, it's a bit of a mixed bag. Some really strong bullish calls out there, but also some serious caution flags.
Absolutely. We saw a significantly higher volume of posts flagged today, which means a lot more for us to dissect. It feels like the market's kicking off 2026 with some aggressive plays and, frankly, some equally aggressive warnings.
Let's jump right in then, starting with MSTR, or MicroStrategy Inc. Now, social media chatter suggests a highly bearish outlook for short-term gains, with users calling out high risk and low probability for quick wins.
And for good reason, Ethan. MSTR's debt-to-equity ratio is a staggering 14.147, showing substantial leverage. Plus, the stock dropped around 50% in 2025, and it's currently trading near its 52-week low. The high beta of 3.41, while indicating potential for big moves, also means significant downside risk. My AI-generated insights still classify this as a stay away, consistent with our previous ratings.
Yeah, even with Bitcoin's recent push above 90K, the company's valuation is too intertwined and volatile for short-term speculation. Definitely a stay away. Next up, ZIM Integrated Shipping Services Limited. There's a lot of bullish excitement about ZIM, especially with talk of a potential corporate buyout and claims of significant undervaluation. Some users even cite geopolitical events boosting shipping profits.
While I hear the enthusiasm, Ethan, the KPIs paint a very different picture. ZIM has an alarming debt-to-equity ratio of 140.799. That's a huge red flag. Their revenue growth is also deeply negative at negative 35.7%. And that incredibly high dividend yield of 19.53% often suggests market skepticism about its sustainability, not robust health. While M&A speculation is interesting, the underlying financial health is concerning. ZIM was never rated by us before, and my analysis points to a stay away until we see concrete details on any acquisition.
Agreed. The buyout is a huge if. The fundamentals are just too shaky for me to be optimistic right now. Stay away for ZIM. All right, let's talk Apple, AAPL. One user made a bearish bet with put options, but the broader community seemed to push back, suggesting it's bold to bet against Apple. There was even chatter about packed stores before Christmas, hinting at strong earnings.
That skepticism is well-founded, Ethan. Apple's return on equity is an exceptional 171.42%, and their net profit margin is a healthy 26.91%. That demonstrates incredible efficiency and profitability. Plus, insiders have been net purchasers of shares in the last 6 months, signaling confidence. While there's news about Vision Pro headset manufacturing cuts, Apple's diverse ecosystem and sheer financial strength mean it's unlikely to significantly impact those core KPIs. We last rated AAPL as a buy in November, and my analysis confirms we should buy again.
I like that. Apple just keeps proving itself. It's a buy for me too. Now, SLS, SELLAS Life Sciences. There's a massive amount of bullish sentiment around this biotech, driven by what users are calling exceptional clinical trial results for their cancer therapies, and critically, the expectation of an imminent buyout. People are talking about multi-billion-dollar valuations. Whoa, slow down there, Ethan. While the social media community is very bullish, especially with that Phase 3 trial update being interpreted positively, the company's KPIs are still those of a pre-revenue biotech. We're looking at negative EPS, a 0% net profit margin, and an incredibly high price-to-book ratio of 11.92. This means its valuation is purely speculative, betting on future success and that massive buyout. The high beta of 2.515 also signals extreme volatility. This is a very high-risk play. SLS has never been rated by us before, and while the potential is exciting, my AI-generated insights strongly recommend stay away from most investors. It's true, the numbers aren't there yet, but the community optimism is off the charts. It's a binary outcome, and that Phase 3 data could be huge. For aggressive investors with conviction in that buyout thesis, it's definitely something to watch. But for the general audience, I agree, the risk is too high. So stay away for now, but with an asterisk. Moving on to MU, Micron Technology. The sentiment is very bullish, fueled by a recent rip in the stock price and news of Micron crushing earnings. Many users are celebrating significant gains. And the KPIs certainly back that up, Ethan. Micron's current price is almost at its 52-week high, validating those huge gains. They also have strong fundamentals, with revenue growth at 56.7% and a net profit margin of 28.14%. What really stands out is the significant insider buying over the last 6 months, over 30% net shares purchased by those closest to the company. That's a powerful vote of confidence. We last rated MU as a buy in November, and my analysis confirms it's a buy again. Hard to argue with that kind of momentum and insider confidence. Definitely a buy. Okay, let's talk about Google, Alphabet. The discussion around this stock is overwhelmingly bullish, with one user reporting a 47% return in 2025 and owning a substantial number of shares and calls. Alphabet continues to show incredible financial health. We're looking at strong revenue growth of 15.9% and an impressive net profit margin of 32.23% and a very high return on equity at 35.45%. These are the marks of a fundamentally robust company. Also, there's been significant insider buying over the last 6 months. We last rated Google as a cautious buy in November, but with these strong indicators and continued market confidence, my analysis now upgrades it to a buy. That's great news. Alphabet's consistent performance and innovation make it a compelling long-term hold, and that upgrade is well-deserved. It's a buy. Next, Nebius Group and V. There's a cautious bullish sentiment for Nebius, mainly around its AI sector potential, but also a lot of talk about high volatility and bag holding from prior high prices. Ethan, despite the hype, Nebius is a stay away in my book. The company has a negative EPS of negative 0.19 and a deeply negative operating margin of negative 0.89. This means it's not profitable from its core operations. They also carry a very high debt-to-equity ratio of almost 95%. While analysts predict triple-digit revenue growth for 2026, current profitability is non-existent, and the stock's volatility is extreme, as users mentioned. We've consistently rated Nebius as a stay away, and my analysis confirms it should remain a stay away. I appreciate the vision for AI, but the fundamentals just aren't there yet to justify a purchase, especially with that kind of debt and unprofitability. Stay away. Finally, RDDT, Reddit Hint, another stock generating a lot of buzz. The original post highlights great gains from being heavy long on RDDT in 2025, specifically mentioning successful option sales income. Analysts are even calling it a potential big AI winner.
Well, the gains for early investors were indeed great, Ethan, with the stock soaring from its 52-week low of $79.75. However, my AI-generated insights classify RDDT as a stay away for new investors. The price-to-earnings ratio is an astonishing 106.56, indicating extreme growth expectations are already baked into the price. More concerning is the significant insider selling over the last 6 months, with net shares sold amounting to nearly 39% of total insider holdings. That's a strong countersignal, suggesting those closest to the company might feel the current valuation is stretched. We've kept RDDT as a stay-away or speculative gamble, and this analysis keeps it at stay-away. Yeah, that insider selling is a tough one to ignore, even with the AI buzz. I have to agree, stay away for RDDT.
All right, Ethan, let's round up our market commentary for today.
Absolutely, Brooke. Based on our AI-generated insights and market commentary, here's our compiled list for deeper analysis. Investigate as buy: Apple Inc., AAPL, Micron Technology Inc., MU, Alphabet Inc., GOOG. Investigate as cautious buy: none. Investigate as speculative gamble: SELLAS Life Sciences Group Inc., SLS. And that wraps up another episode of the Daily Hunt for Multibaggers. Just a reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in, everyone. We'll catch you next time. Happy hunting!